Hey YouTube, this is Zach with Achilles Financial, and today I want to talk about something that's rapidly spreading across the internet right now, which is the potential for a new tax plan. This is something that I have been discussing in earnest since Biden was elected last November. The key ideas here that I want to be focusing on is if a tax plan is passed, where would that affect, who would that affect, and how can we plan accordingly. So I want to focus on a few key items here that are coming from a Fox Business report that you can just see on this screen page right here. I'll include this in an article down below. The key items that we're talking about right now is, of course, the first and foremost, raising the corporate income tax to 28% from 21%. Overall, I think that this isn't going to hit as bad as I had initially feared. I was originally thinking it would be closer to 30%. And all in all, I do think that this is going to have a negative impact on companies, as taxing always does. But I don't think that this is necessarily the worst thing that could happen. You are going to see this squeeze small business more so than big business. But let's just take an example of where we may see some of the impacts of this using a company that we've covered here on the channel multiple times in Microsoft. So using Microsoft Corp, again, on TD Ameritrade's platform, you can see I've got all of their income statement information right here. In 2020 last year, because this is what we're going to be covering as of 6/30, they've since brought in significantly more. But what we want to talk about is the income before tax number right here. Values are displayed in millions, keep that in mind. This is $53 billion. So this is straight income. So after tax, after they provide $8.7 billion to the taxman, you can see that they still have $44 billion left over. So the effective tax rate here, keep in mind that we in the United States utilize something called a progressive tax system. That means that as you go up in income, you are taxed in different brackets. So for example, if your initial income tax bracket is up to $100,000, will be 10%, you will be taxed 10% on that first $100,000. If from $100,000 to $200,000, your tax bracket is 20%, you would not, if you make $150,000, be taxed 20% across $150,000, but rather you would be taxed at $100,000 for the first, or you would be taxed at 10% for the first $100,000 and 20% for the second $50,000. So despite the fact that we have a corporate income tax of a 21%, what you see here is actually more of an effective tax rate of right at 19% between these two numbers. Admittedly, there is the potential for rounding adjustments. So if this is at a combined tax rate of 19%, then what we would actually see if we change just the income, so of course there would be all of the manipulations and credits and what have you, but just the changes that you would see here, Microsoft would end up owing right at $2.5 billion more dollars. So that would drop their overall income after tax from 42.2. We'll just call it straight at 42 billion, adding 2 billion to the bottom line. Now, my only concern with this is that companies will obviously be moving money away from how this could benefit shareholders, because again, then this number right here is what you see go directly to dividends. It's what you see go directly to the shareholders in the form of earnings per share, which increases the value of the stock. So that is a concern of mine. And I would not have a problem with a company like Microsoft paying an additional $2 billion more if I believed that the government was going to utilize that money effectively. That is my concern, because I think that Microsoft is going to do a better job with $2.5 billion rather than the federal government, since they don't do a lot in a very profitable or efficient manner. But that is just my opinion. That is something that I want to highlight here, is that again, they would owe an additional $2 billion, which again would affect a lot of the capabilities of what they could do down below. You can see some of the earnings per share capabilities, as well as just the different approaches here. So again, you see an earnings per share, we'll look at the diluted of 576. This would obviously go down. Again, though, you'd probably see this at 550. And then you can see the share purchases as well as dividends would also go down because they'd be coming from these numbers above. Now, do I think Microsoft is at risk of lowering their dividend? I don't. This could curtail future increases in the dividend, though. So this is step one. So let's talk about some of the other things that are in the tax plan. So the second thing on here is raising the income rate on individuals earning more than $400,000. This is something that we have not seen a final of. We haven't seen what this is, but currently the income tax rate is right at 37.5%, give or take a little bit. And so I don't foresee a huge change at this level because, again, this is on realized income. The previous tax rate was 39.4% prior to the Trump tax cuts. So overall, I'm not overly concerned on this particular item here, just because I don't believe it's going to have a huge impact on the overall stock market, because that is the focus of this video and this channel. But I do think that this is going to have an impact on those individuals. What is going to have a much more expensive and painful impact is going to be expanding the estate tax, so how much they taxed someone's death, as well as creating a higher capital gains tax rate for individuals earning at least $1 million annually. This is a huge issue that I see because, again, the majority of shareholders in the United States are individuals who are owning at least $1 million. So as much as we like to talk about the retail investor, oftentimes you're going to see that retail investor is not the one moving stocks. So let's kind of dive in onto this point right here. So this is a website called Wallet Hacks where I'm pulling this information. All of it is as of 2016. This is the most comparable information I could grab in a reasonable time frame. So feel free to do your own research, although I still think most of this is going to be applicable. As you can see here on the screen, what I want to focus on is 92% of that top 10% of income earners does own stock. So because of that, I want to be watching this and saying, well, if there is a impact on capital gains tax, who is going to be moving their money? Well, out of that 92.3%, the median value is $425,000. So obviously we are going to be seeing a lot more than what we see right here, or you are going to have a lot of borrowers with more than $425,000. A lot of them will have multi-million-dollar stock portfolios. A lot of these individuals will be older individuals. So this is not just the venture capitalist startup who went out and made a ton of money. This is oftentimes going to be older individuals who are going to have that exposure to the market. Now, keep in mind, also inside a lot of those breakouts, who is not going to have to be paying on a lot of the stock incentives or on the realized capital gains, is anyone who is in a tax advantaged account, such as a pension, such as a 401k, such as a Roth. So there's a lot of moving parts to this right now. The key things that I want to highlight, though, is that most of what people own from a stock percentage wise is owned by those in the upper percentiles, as well as they own a higher value, which means that if there's a change to the capital gains tax or a quote unquote wealth tax, these people will be pulling their money out and moving it elsewhere. For that reason, I think that is the largest risk to the market today, is the fact that, again, a lot of these people would be moving their money out of the market and into a place where you would not be getting those tax pain points, I will say. So this is just some of the items that are included in that tax bill. All of this has just been discussed at this point in time. We haven't seen any details at this point, although there has been some pre-election type of proposals. I am interested to see what the final information is, and when that happens, I don't think that the market will react appropriately. That being said, throughout time, the stock market has continued to go up under a variety of tax regimes, and because of that, I still think from a long-term perspective, the stock market is still a lot better than having your money in a bank. So I'll link this article down below. If you have any questions about this, feel free to ask me in the comments below or in the Discord. And if you find this content helpful, please leave a like and subscribe. Thanks, everyone. Talk to you later.